For those of you new to this channel, my name is Dan Johnson. I spent 15 years at Boeing and Amazon doing everything I was taught. Work hard, move up the chain, max out the 401k. Then I sat down with a financial advisor to find out when I could retire. And what I heard crushed me. Work longer, save more, lower your expectations. I refused to accept those options. What I discovered changed everything. And now I'm on a mission to educate corporate America professionals about the financial options available to you so you can generate the maximum amount of retirement income using the least amount of dollars. Let's get into it. In my last video, we talked about the importance of building a diversified portfolio, one where every asset plays a different role. So when one position is down, another position picks up the slack. Today, I want to challenge something most corporate America professionals have been told their entire career, that bonds are your only safety net. That when stocks fall, bonds rise, and your portfolio stays balanced. It sounds logical. It's been repeated so many times, it feels like financial law. But the data tells us a different story. And if you're counting on bonds to protect your retirement when the market turns ugly, this video is for you. I want to be clear before we go any further. This isn't a hypothetical risk I'm warning about. Starting in March, inflation has exceeded 3%, and May came in at 4.2%. The Strait of Hormuz remains closed, and even when it reopens, energy markets won't normalize overnight. Tariffs aren't going away anytime soon, and energy and food prices, they keep rising. So before I show you what the data says about what happens to your portfolio when inflation is on the rise, I want you to sit with one question. Is your portfolio built for the environment we're in right now? For roughly 25 years, from the internet boom of the 90s through pre-COVID times, bonds largely did the job we were told. Stocks dropped, bonds rose. The 60/40 portfolio looked like a masterpiece of financial engineering. But here's what most people never hear. That 25-year window was the exception, not the rule. According to Russell Investments research, since the 1960s, the US stock bond correlation has been positive more often than not, meaning stocks and bonds have spent more time moving in the same direction than in opposite directions. So we haven't discovered some brilliant investing strategy. We got fortunate with an unusually long period of low inflation and falling interest rates. And we are building entire generations of retirement plans around this. But here's what the data actually shows. And this is the part I want corporate America professionals to pay attention to. Russell Investments built a model showing exactly how the relationship between stocks and bonds shifts as inflation rises. And the numbers are striking. When long-term inflation is below 2%, the environment we enjoyed for most of the 2000s and 2010s, the stock bond correlation sits between minus 0.96 and minus 0.99. Bonds and stocks are moving almost perfectly opposite each other. The safety net working as advertised. Even at 2.5% inflation, the correlation is near zero. Stocks and bonds showing almost no relationship to one another, letting bonds still serve somewhat of a defensive purpose. But watch what happens as inflation climbs. At 3% inflation, the correlation turns positive, ranging from plus 0.04 to plus 0.49. Stocks and bonds now moving in the same direction at the same time. And at 3.5% inflation, the correlation reaches as high as 0.66. At that point, bonds aren't just failing to protect you, they're moving in lockstep with your stock losses. Remember where inflation is right now. Then look at those numbers again. We aren't talking about a distant risk. We are sitting inside the inflation range where the data says your bond allocation stops working. And we have recent proof even. Let's go back to 2022. According to JP Morgan in 2022, stocks fell approximately 25% peak to trough, and treasury bonds, your protector, dropped roughly 17%. The safety net didn't just fail to catch you, it fell with you. Here's the mechanism in plain English. In a low inflation environment, when stocks fall, the Federal Reserve cuts interest rates, which makes money easier to obtain, which drives demand, which stimulates the economy. And when rates fall, bond prices rise. That's the safety net working. The Fed having room to act and bonds able to respond. But in an inflationary environment, the Fed's hands are tied. They can't cut rates when inflation is running hot. Because cutting rates, that injects more money, drives up demand, and would push inflation even higher. So the Fed has to raise rates to steady inflation. And when rates rise, bond prices fall. So at exactly the moment your stocks are getting crushed by inflation and rising rates, your bonds are getting crushed by the exact same forces. Different assets, same enemy, zero protection. So what can be relied upon as your defensive asset during the conditions that matter most? McKinsey research tracked 7 inflationary periods from 1980 to 2022 and found commercial real estate outperformed bonds in 6 of those 7 periods. And here's the kicker, it outperformed stocks in 4 of the 7. Real assets with limited supply and tangible cash flows, like rental income, have built-in inflation sensitivity that bonds simply can't ever have. But for corporate America professionals who aren't real estate investors, there's a more accessible answer that almost nobody educates you about because it doesn't fit neatly into your 401k or brokerage account. Insurance products, specifically annuities and whole life insurance. I know what most of you are thinking. Those are your grandparents' financial products. Boring, low return, not relevant. But here's the truth. Fixed annuities and whole life insurance are non-correlated assets. They don't trade on exchanges. They aren't subject to market fluctuations. When stocks fall by 25% and bonds fall 17% simultaneously, like in 2022, a properly structured annuity or whole life policy doesn't move with them. Your principal protected. Your guaranteed growth continues. That alone makes them something bonds can no longer claim to be, a true defensive asset. But here's what makes them even more compelling. The strongest mutual life insurers in this country have paid dividends to whole life policyholders every single year for over 100 years. Think about that. They paid through the Great Depression, 2 world wars, through high inflation years of the 70s and 80s, through the internet bust, the Great Recession, even through COVID. Every single one of those environments crushed other asset classes. But these insurers kept paying. That isn't luck. That is actual structural resilience built into a product. And both annuities and whole life insurance offer riders that can be built in to offer additional inflation protection. That's a true diversifier. That plays its role when you need it most. Bonds have their place, but they cannot be your only line of defense. And the data is clear about why. Bonds protect your wealth during calm, low inflation periods, but they fall during volatile, inflationary periods, which is precisely when your income and retirement savings is most vulnerable. Real portfolio diversification isn't holding 2 assets that move in opposite directions sometime. That isn't each product playing its role. Real diversification means having assets that are genuinely protected when everything else is failing. Assets that don't just survive, but continue performing. The question isn't whether inflation is a risk right now. We already know the answer to that. The question is whether your portfolio is built for it. Because the corporate America professionals who retire on their own terms are the ones who truly understand what a diversified portfolio is. If this video changed how you think about your current allocation, I want you to take one action today. Book a free strategy session. We'll look at exactly where you stand, identify your real exposure, and explore whether insurance based or other fixed asset products deserve a role in your retirement plan. Comment in the notes to let me know you're interested, and I'll reach out because it could be the most important conversation you have about your retirement this year. If this added value, hit subscribe and share it with a corporate America professional who needs to hear this. New video every week. I'll see you in the next one.